Hedge funds are investment funds that pool capital from different accredited individuals and institutional investors and employ various strategies to generate absolute returns. These funds are managed by professional investment managers, often referred to as hedge fund managers, to maximize returns and mitigate against risk. A hedge fund's purpose is to maximize returns and eliminate risk. Hedge funds aim to generate absolute returns for their investors. Welcome to Atlas Crossings. The use of hedge funds in financial portfolios have grown dramatically over the years. A hedge fund is just a fancy name for investment partnership that has free rein to invest aggressively and in a wider variety of financial products than most mutual funds. In fact, most hedge funds, if you go to most hedge funds website, they wouldn't refer to themselves as hedge funds but alternative investment funds. Hedge funds typically have a more flexible investment strategy than other investment funds. And unlike the traditional investment funds, hedge funds are more flexible in their investment strategies. They can invest in a wide range of assets, including stocks, bonds, but can also invest largely in derivatives, commodities, currencies, and different alternative investment options. They often use leverage, and in other words, they borrow to increase investment exposure as well as the level of risk. And they do this to amplify the returns they're able to get, which can also increase the level of risk they're exposed to. We can see hedge funds using quite a lot of short selling and speculative investment practices, which is not typically available to mutual funds. Now, compared to other types of investments, hedge funds are lightly regulated, in some places unregulated, by the federal government, particularly in terms of what they are required to disclose to the Securities and Exchange Commission. The name hedge fund came from the fact that the investments were often chosen as a hedge against potential risk. They were chosen to protect against declining markets. Hedge funds find their success in utilizing complex trading techniques and instruments, focusing on risk management and leveraging short selling. The hedge fund market is quite a huge industry. It is estimated to be about $5 trillion US. We have a range of top players, top hedge fund managers. An example of that is the biggest hedge fund currently, Bridgewater Associates. Bridgewater Associates has an asset under management of about $126 billion. Hedge funds are characterized by active management, which attempts to provide higher returns than the market, irrespective of the market conditions. As such, there are differences in fund management styles, ranging from high risk for aggressive investors and a lower risk approach for investors and institutional investors like pension funds and other conservative type of investors. You generally must be an accredited investor or described as an accredited investor, sophisticated investor, or a registered investor to be able to invest in a hedge fund. This means that you have to understand the level of risk. You have to also have the minimum level of income and assets to invest in a hedge fund. Typically, investors include institutional investors such as pension funds and insurance companies, and of course, wealthy individuals, the high net worth individuals. It is important to understand that the hedge funds are not subject to some of the regulations that are designed to protect investors. But seeing how much assets they manage, we can say they are quite an attractive bunch of investment managers. Depending on the amount of assets in the hedge fund advised by the manager, some hedge fund managers may not be required to register or file public reports with the Securities and Exchange Commission. Nevertheless, hedge funds are bound by the same anti-fraud regulations as other participants in the market, and their managers have a fiduciary obligation to the funds that they oversee. Here's the question I always get. Are hedge funds riskier than other investment funds? There is a general belief that hedge funds are very risky. And looking at their strategies, one might agree with that. You generally must be an accredited investor, meaning that you must have the minimum income and assets. You must understand the high levels of risk. You must be a registered investor to be able to invest in a hedge fund. With hedge funds not being subject to certain regulations that provide protections for investors, they can also be seen to be quite risky. The utilization of leverage, derivatives, investing in currencies, short selling, and using speculative instruments create various levels and significant levels of risk for investors. However, hedge funds also employ these methods as a risk mitigation strategy. They can also hold significant amount of cash depending on the market condition, which means they can hold different type of assets that are liquid and safe in different market conditions. Hedge funds have the flexibility to adopt any strategy in managing their funds, which may involve maintaining substantial cash reserves and investing in low-risk assets. The primary objective of a hedge fund is to achieve absolute returns regardless of the prevailing market conditions. But we agree, just as a hedge fund's aggressive investment strategy may be positive, they can also be a pitfall. An example of this is a hedge fund known as Melvin Capital. Melvin Capital had a significant short position in GameStop. According to Wall Street, Melvin Capital lost about 53% in January 2021, mainly due to the rally in GameStop shares during the time. Fees and expenses affect investors' returns. Hedge funds typically charge an annual asset management fee of 1% to 2%, as well as a performance fee of up to 20% of hedge funds' profits. Of course, these fees are typically higher than other investment management funds like mutual funds. But of course, the argument is charging a performance fee can motivate hedge fund managers to perform better. But it can also mean that they are forced to take on higher levels of risk to be able to generate those high returns. They typically use what we call the 220 fee structure. Now, under this structure, the fund receives an annual management fee, like we said, of equal to 2%, and then that performance fee of 20%. Investors then get the remaining profit. Now, for instance, suppose a hedge fund oversees a $1 billion in assets and achieves a 10% return over the course of a year. This will result in a 20 million earned in investment management fees and an additional 20 million in performance fees. This amounts to a significant income for the hedge fund. Post-COVID, hedge fund fees have experienced a drop, this as a result of lower performance, but also as a result of high competitive hedge funds. Some other hedge funds have found a way around the fee structure, and they've used something called the high water mark. This mechanism prevents the hedge fund from collecting performance fees following a period of negative performance. Instead, the performance fee is only charged on profits exceeding the investor's previous highest investment in the fund. And of course, we've seen several investors move away from charging these high performance charges. They've moved away from the traditional 220 fee structure to alternative investment or alternative fee structure, such as having a 0% management fee and then having a 30% performance fee, which is taken back end. The question is, are the high hedge fund fees justified? That is a question we would answer in another video. If you like this video, don't forget to like, subscribe, and continue to show up.